Welcome to Investment Strategy. I'm Vishal.
Hey, I'm Sharvari.
Markets haven't fallen sharply, but they are not really moving up either. And that's because there are multiple pressures building at the same time. Right, Charvari?
Yes, oil is still close to $100. Global interest rates are high, and money from foreign investors continues to move out of India.
So the big question is, in this kind of market, how should you invest?
Stay with us till the end because we have 5 mutual fund model portfolios for aggressive, moderate, and conservative investors with fund ideas you can use right now.
And we'll also tell you what to avoid chasing because that's where many investors go wrong in phases like this. Sharbari, can you walk us through how markets fared last month?
Sure, Vishal. As of 27th May 2026, mid-sized and smaller companies did better than larger companies.
The Nifty Midcap 150 went up 3.02%.
And the Nifty Small Cap 250 gained 2.32%.
The Nifty Next 50 also moved up by about 2.03%.
But the Nifty 50, which represents the largest companies, was almost flat and actually fell slightly by 0.23%.
So the takeaway is simple. Stocks beyond the top 50 companies did better this month.
Agreed, Vishal. But it still wasn't a strong rally. The gains were controlled, which tells you investors are participating, but they are being careful. And that same caution shows up when you look at sectors. Right, Vishal?
Exactly. Some sectors did well, but others clearly struggled.
Pharma was the strongest, gaining 6.7%.
Metals were also strong, up 5.2%. Chemicals added 4.9%.
Autos moved up by about 4.2% and defense stocks gained 3.8%.
But then on the other side, financial stocks were weak.
PSU banks fell around 4.5%.
And consumer durables dropped sharply by about 6.5%.
Even sectors like FMCG and real estate did not do much.
So instead of everything going up, only certain pockets are performing. Am I right, Sharvari?
Exactly, Vishal. And that's usually a sign of a cautious market.
Now let's understand valuations, because that tells you how expensive or cheap the market is.
The Nifty 50 forward price to earnings ratio is at 19.05.
And that's come down from 19.66 last month.
Also, it's still below the 3-year average of 20.4.
So, markets are not very expensive, but they are not also cheap enough to drive a sharp rally.
Absolutely, Vishal. Plus, flows are the bigger issue right now.
Yes, foreign investors have sold more than 2.6 lakh crore rupees in 2026 so far.
That's a massive amount of selling, isn't it, Vishal?
Yes, but the only reason markets have not fallen sharply is because domestic investors have been buying consistently.
So, local money is supporting the market even when the global money is moving out. Now, let's step back and look at the global picture, because that's where a lot of this pressure is coming from.
Globally, there is a split situation.
On one side, sectors like AI and semiconductors are doing very well.
In fact, markets like South Korea saw gains of around 20 to 25% in May.
But on the other side, interest rates remain high.
The US 10-year yield is around 4.5 to 4.6%,
And the 30-year yield has gone above 5%.
which basically means borrowing costs globally are high and may stay high.
For India, one more factor is very important, and that is crude oil.
Even now, close to $100 per barrel, oil continues to put pressure on inflation and currency.
Absolutely, Vishal. The rupee has weakened to around 95.79 against the dollar.
And that's one reason why Indian markets have not moved up like some other global markets.
Let's now talk about inflation and interest rates in India.
Consumer inflation is at 3.48% for April, so still within RBI's comfort zone,
But wholesale inflation has jumped to 8.3%.
which shows that costs are rising in the system.
That's why bond yields are still high.
The 10-year government bond yield is around 7.01%.
Earlier, markets were expecting rate cuts.
Now, the expectation is that rates may stay at these levels for longer.
And the RBI is most likely to maintain the repo rate at 5.25% for now. So, Vishal, given all of this, what should investors do right now?
I would keep it very simple. First, don't chase sudden upward moves in the market because those moves may not be backed by strong conviction yet. Second, invest gradually instead of putting all your money at once.
Basically, spreading your investments over time reduces risk,
Exactly. And third, focus on allocation.
meaning balance between different type of funds.
Yes, use large cap funds for stability and add mid and small caps over time.
And does gold still have a role?
Yes, but mainly as protection, not as your main return generator.
Now let's come to the most important part, the model portfolios for June 2026.
Right, starting with aggressive investors. This is high growth, so more exposure to large caps, mid caps, small caps, plus flexi caps, thematic funds, and even global allocation.
So higher volatility but higher return potential over time, right Vishal?
Exactly, Sharvari. Now the moderate portfolio balances things out.
Here you still have equity, but also balanced advantage funds, corporate bonds, short duration funds, gold, and global exposure.
So you are reducing risk without stepping out of growth.
Then comes the conservative portfolio.
Mostly corporate bonds and short duration funds with limited equity and some gold. So the focus is capital protection.
Now, apart from these, there are two more buckets.
Yes, first, the regular income basket.
This combines balanced advantage, multi asset, and selective equity to aim for more stable returns,
And finally, the Build India basket.
which focuses on India's long term growth themes through consumer, manufacturing, and diversified equity exposure.
So instead of guessing the market, you just pick the allocation that suits you.
Before we wrap up, we want to hear from you.
Do you think markets will remain range bound? Or do you expect another sharp move?
And what's your investment strategy right now? Buying on dips, continuing your SIPs, or waiting on the sidelines?
Tell us in the comments, and if this video helped, like, subscribe, and share. Happy investing.
Mutual fund investments are subject to market risk. Read all scheme and related documents carefully before investing.